Welcome back. In this final video for Chapter 2, we're just going to see how we take all that information that we just created in all those journal entries and how we move through the rest of the accounting process to get to a trial balance. The next step in this is posting to the general ledger. Now, why do we do this? Well, one of the big reasons is because our journal entries were all in chronological order. We make journal entries as accountants as soon as events happen in a company. But that means, and if you go back to all of the entries we just analyzed and journalized for the high-tech company, that example in your book, if you notice, different accounts were being affected in different journal entries, and it's very difficult to just follow through what happened, for instance, to the cash account, because everything was in chronological order, not in account order. So what we do is in the general ledger, every account has a separate page, and we follow all the transactions to that particular account that occurred during the month. When we post, we transfer all those journal entry transactions right on to the general ledger for that account. And the general ledger is the collection of all the individual financial statement accounts that a company uses. Remember that chart of accounts we said that every company has? Well, their general ledger follows all of the journal entries that occurred to all of the accounts on its chart of accounts. So let's look at what would have happened to all those high-tech entries that we made. What happens is all of the journal entries that we made for high-tech, they each have a linked info on the general ledger, and each account has a number, so every journal entry gets a posting reference and it links directly to the general ledger. Let's follow that. Remember those 13 transactions? Well, for every single one of them, there was a debit and a credit. So for transaction number 1, there was a $12,000 entry debit to cash, and there was a credit entry of $12,000 to common stock. Notice these are T accounts, right? And T accounts always have the debits on the left and the credits on the right. So when we looked at transaction number 2, and I would encourage you, go back through your book, follow pages 74 and 75, look at every single one of the 13 transactions that high-tech did and see if you can figure out where it ended up on each one of these accounts. The second transaction had a $3,000 debit to cash and a $3,000 credit to the liability account notes payable, because that was when they borrowed $3,000 from the bank. For the fifth transaction, if you recall, they got $6,500 in supplies, which was an increase to the supplies asset account, but they purchased it initially on credit, which was an increase to the accounts payable liability account. If you follow every single one of the transactions in high-tech, you will discover that all of them affected one of these listed accounts at least once. Notice the cash account had both debit effects and credit effects. The accounts receivable account had both debit effects and credit effects. But most of the other accounts had only a debit or credit effects. Service revenue only had credit effects. Salaries expense only had debit effects. Utilities only debit effects. If you add let's go back to the cash account, all of the debit entries, and then add all of the credit entries, I had $12,000 plus $3,000 is $15,000, plus $8,800 is $23,800, plus $9,000 would be $32,800, plus $3,000 is $35,800. There was an associated $19,200 in credits. So if we take the $35,800 in debits minus $19,200 in credits, we would come up with a debit balance, because there are more debits than there are credits, a debit balance in cash of $16,600. That's how that works. Notice, accounts receivable has total debits of $3,300, total credits of $3,000. That leaves it with a debit balance of $300, $3,300 minus $3,000. Accounts payable has total debits of $6,000, total credits of $6,500. There are more credits than there are debits, and there are more credits by $500. So it leaves it with a balance of $500 credit in accounts payable. Does that make sense? So then what happens in the fourth step is we prepare a trial balance. I take a list of all the active accounts for that company and each account's debit or credit balance. Notice back here, debit balance for cash of $16,600, debit for accounts receivable of $300, debit for utilities expense of $5,200, credit from common stock of $12,000. We would take all of those and we lay them all out. The trial balance on March 31st, 2011 for High-Tech Communications we start with the $16,600 debit balance to cash. The $300 debit balance from accounts receivable. Again, we're pulling all of these from the final balances on the general ledger. If we added up all of the debit balances and then all of the credit balances, we should find that the debits equal the total debits and the total credits should equal each other. If they didn't, and this is why we call it a trial balance, then you would have to go back and find one of the accounts where there is an error, or maybe multiple accounts where there was an error. But if your trial balance has total debits equaling total credits, then you would know, as an accountant, that you were ready to move on. You would be prepared to go to step 5 and step 6 in your accounting cycle, which we won't be covering in this chapter, but you would be better prepared to actually create the financial statements. Now, I would highly encourage you to get a little more practice. Follow the review problem on pages 81 through 85 in the review section at the end of chapter 2. It follows through a series of transactions just like the high-tech ones, where you can analyze the effects on the accounting equation, you can journalize it, you can post it to the general ledger, and prepare a trial balance. This is good practice so that you can understand all the pieces that are involved in the accounting cycle.